everyone, and welcome to a very special episode of Buy Now, Sell Now on campus. We've traveled all the way to the UAE at the coveted SP Jain Global School of Management in the heart of Dubai. Today, the bright, young and vibrant minds will be questioning a market expert on the learnings of investing and the stock markets. So let me introduce and bring on board a guest who really needs no introduction. He had his first brushings with the stock markets in 1982 and now is known as the alchemist of Dalal Street. None other than Shankar Sharma, who is with us. He's the Vice Chairman and Joint Managing Director at First Global. Shankar, thank you so much for joining us today. Now, it's been a very interesting journey. You've built your investment profile over the last 3 decades, and it just shows that patience is a virtue, that you need to start young. Can you tell us about your learnings in the stock market?
Yeah, my learning in the stock market was because in our home, I come from a small town called Dhanbad, where I was born, and I studied till school there. And one of the tenants in our home used to fill out these IPO forms, and one day I asked him, and my father had just died in '81, so I wanted to get rich quick. We didn't have a lot of money, we just had the rental income, and so I said, well, I have to figure out a way to get rich quick, legally. And this guy was filling out these forms, and I asked him, Uncle, what are you doing? I keep seeing you sitting on this jhula and doing this every day. And he said, son, this is something called, a public issue. It was used to call public issue then. And I said, what is a public issue? He said, look, when you apply, you give 10 rupees to this company and the stock will become 100 rupees. I said, how can that happen? I mean, this doesn't seem right. He said, no, try it. So I borrowed 2,500 rupees from my mother, and I put it into one company called Asian Hotels, which has this Hyatt Regency in New Delhi. Okay? And I thought, hotel business looks like a good business. I mean, I was a kid, I had no idea what I was doing. And that became, I bought it at 10 rupees, became about 250 rupees, and suddenly I was a rich young kid. And I said, this looks like a good way to make money. And then, of course, in 1984, a big boom happened when Rajiv Gandhi became PM, and, it's just, I think it's all, in a lot of senses, your basic desire, and the desire for me at that point, the motivation was that I had no other income. I had to fund my education. So I had to get some money, which was, it was non-linear money, and stock market gave me that non-linear money.
Okay, that's a very interesting story. You've, it's been very inspirational as well. But let's open the floor to all of the students and get in some questions for Shankar Sharma, who has the first question.
Hi, Mr. Shankar Sharma. I'm Shirley from Philippines. Could you tell us the long-term outlook is for India, and how do you view India as an economy versus global developed market?
India is a little different from the rest of the Asian pack. And maybe it's not growing as much, but maybe it's safer, because the macroeconomic profile of India is very different from that of the rest of the emerging Asian economies. That was, in my view, the seminal point at which the world started to look at India differently. And of course, since then, the next crisis that happened was basically the 2008 crisis. There was a dot-com crisis in the middle, but that was a small one, very segmented to a particular industry, not really a macro crisis. The next macro crisis that happened was 2008. There again, you saw the Western economies collapse. You saw some Asian, or let's say emerging economies collapse. You saw China go into a big problem. You saw Brazil really collapse, Russia collapse, but India didn't. So that was the second point at which the world suddenly said, all right, so there are 2 big crises in the last 20 years where India has come through as a good, safe economy. And the reason for that, I'll tell you, is very simple. The management of the Indian economy is in the hands of the RBI in terms of the monetary policies, the fiscal policies with the parliament. But at both levels, India is a conservative country. India does not believe in taking excessive risk. And it is very important for all of you to understand. India will never ever run an economy wherein we are going to be spending like China has done to build a huge debt bubble. And China says, all right, I'll build the debt bubble, the debt will take care of itself, let me build the highways and the freeways and the motorways. That's one approach. India will say, we will build, but we'll build a little slowly. We'll not build a huge debt burden. So you look at debt to GDP for India, 60% to, if you look at the local currency debt. Foreign currency debt is almost negligible. So therefore, given all this, I think the outlook for India incrementally always has been good for the last 20 years, but incrementally is, in my view, the best of all emerging markets now. And in particular, smaller Indian companies, if you have money to put in, I think you should buy the funds of the Indian small cap funds. I think without using a lot of the brains, you can still make serious money in the next 3-4 years' time.
So broader markets is where you
Broad markets are looking very, very. I've said this for the last 3 years, and I think this for the next 3-4 years, I see just a secular bull market.
Good morning, sir. I'm Siddharth. I'm currently pursuing my Master's in Global Business degree, specializing in contemporary marketing management. My question to you is, being a first-time investor, what are the 3 key points that you consider before making an investment?
Over time, I mean, the first thing is that in investing, keep an open mind. Okay, and one of the biggest mistakes people do, and all of us end up doing that because of your own personality, your thinking, you end up getting straitjacketed into a certain linear view of looking at companies. Okay, and Warren Buffett is a very good example of how his linear thinking has prevented him from buying a Google or an Apple. Of course, he's bought very, very late, much after Apple's story has peaked out. Never bought Facebook, never bought Netflix. Just because he said, I will not buy technology. Okay, so he made that one statement 20 years back. Now, because of that, you become prisoner to your own mindset. Second thing, of course, is, again, quality of management, etc. I'm not a big believer in that because, in my view, we only can know that in hindsight. We never know when a company is starting out what the quality will be. You have no idea. It's only after 5 years of data that you can tell. By that time, anyway, you're too late because the stock has already delivered most of the promise in that. So, therefore, I'm not a big believer in quality of management by and large. Of course, HDFC Bank, we all know, good quality of management. We knew that back in 1996 because I had worked with Aditya Puri. But those are exceptions. So I'm not getting into quality. And that's again a subjective thing, what do you mean by quality of management, all right? Never take management's word as the gospel truth because they are human beings and they're more likely to be wrong than be right. And the third thing, of course, is that do a lot of competitor analysis. That is something that we do. We do a lot of that, and we really go deep into understanding why a certain business model is working, why it's not working. And you get a 360-degree view by talking to people around that company.
Okay, so we've really picked your brains on the key virtues for investing in the stock markets. Some other questions then from the audience. Who has a question?
Okay. Right. So I'm Apurva from the Masters of Global Business program here. My question for you is that you have a very specific style of investment. You prefer companies that have been in a multi-year low or are loss-making, and that's really gutsy. But can you tell us a little bit more about your investment mantra and why it has worked?
I don't think it works all the time. It's just that, when it works, it is more than made up for any mistakes that I might have made. But keep this in mind that by and large, I have found that this model of investing at least prevents huge losses because I'm buying it so cheap. I'm buying it so cheap. And remember, these are all listed companies, they're not unlisted. So there is some degree of exit possibility. So trading volume, trading liquidity is important. I mean, I will never ever do a similar thing in an unlisted company, even if it was the same business. But just the fact that if it's unlisted, I'm not touching it. So the thing I always say is that when there's a company in trouble, I always go to Bloomberg and I say, all right, let's look at the analyst consensus on this. And if 9 out of, let's say 20 analysts are covering or 10 are covering and 9 are negative, I said, okay, that's now a starting point. This is interesting. Because remember, in markets, consensus will always be wrong, okay? Remember this. You only have to judge when the consensus is so complete. Okay, so there are degrees of consensus. You can have, let's say, in the 10 analysts, 30 were bearish and 70 were positive. It's not 100% consensus. You can't say
Shankar,
that.
if I may come in here, give me an example of something that you've identified that has fit the bill of what you've just described. Maybe something in the past as well.
I mean, there have been many. Tata Motors was a good example. Yes. Amazon itself was a good example in 2001. Apple was a good example in 2002, 2003, when it was a loss-making company. 7 years after Steve Jobs had come back. Remember, everybody thinks Steve Jobs came back and he waved a wand and things changed. Came back in 96 or 97. Till 2003, the company was still making a loss. Market cap was less than Infosys. Okay? Think about it. So Apple was a good example. IndusInd Bank is a good example. In the last 3 years, specialty chemicals in India have been a terrific trade, beaten down sector, but things were changing in China. We saw that a little ahead of the market, and stocks are up 20, 30 times in the last 3 years. So infrastructure, some of them have done very well, which again, I thought, I was bullish in 2003 in infrastructure, bearish in 2008, then again very bullish in 2012, 13, 14. And a lot of those stocks are up 5-10 times, even from the lows of the last 2-3 years.
So we've really got some in-depth knowledge on how Shankar Sharma likes to pick his stocks and what his view is on the markets. We'll slip into a short break, but stay with us as he joins in on the other side to talk more about what his outlook is of startups and where he sees the Indian markets headed. Come right back. Great to have you back with us. We are in Dubai at the SP Jain School of Global Management campus in conversation with Shankar Sharma. Let's get in some more questions from the students.
Good morning, sir. My name is Joel. You mentioned a while ago about Amazon and Apple. These are one of your most memorable investments overseas. How did you identify these companies? And can you take us through just your valuations process and how it was like?
Yeah. Okay, Amazon was the first one actually. Apple came later. Amazon was, we started covering the stock in I think 2000, 99, 2000, and from there it had fallen like 90%, and that time the whole street was very bullish in the late 90s and the early part of 2000. And Morgan Stanley's analyst Mary Meeker was the cheerleader on Amazon. She was saying that this company is going to become whatever it became. I mean, she was right if you look at a 20-year period. So in all fairness, you must say that, if you look back over 20 years, then she was right. But that's the time when we said, all right, now let's go deeper into Amazon. And the stock was nearly all-time lows. And one thing caught our eye, and which was that we were doing the cash flow numbers, for Amazon, and we found that in that one quarter it had turned in a free cash of $145 or $140 million. Here is a company that turned the corner. At profit, it has not turned the corner, but in cash flow, it has. And frankly, cash flow is what sustains the business and runs the electricity, right? Profit, you can keep showing whatever you want to show, but ultimately, it's cash in the bank will run it. And this guy generally generated 140 when Street is saying company going to bust. That was the catalyst. Right? After that, once a company turns the corner on cash flow, all-time low, at least you're looking at 200% return.
Shankar, I don't know about you, but we've been getting a bit bewildered looking at the screen, the way the markets have been moving. What sectors interest you, and do you think that given the fact that the strong monsoon, with the government, lots of factors working in favor here to continue?
I mean, I have been very bullish on the commodities space, very negative on commodities from 2008. I had changed my view last year in February when oil was 27. And along with that, all commodities also had bottomed out in my view in February 2016. So since then, I've been very bullish on steel. So steel has been a terrific sector. If you look at stocks of all steel or sort of mining companies in India or globally, they have done phenomenally well. So that has been a big sector bet in my view. And again, in another commodity space, as I mentioned, commodity chemicals, again bombed out sector 2013-14. Big turn globally. Stocks have been up. Consumption is iffy. Again, in consumption, I don't find troubled companies. I find good companies. So it doesn't excite me. My view is, I'm not entering stock market to make 15-20%. So I'm very clear. Unless I look at 100% return, I'm better off doing my fixed income.
Okay, let's find out how you guys can also make your 100% returns. What questions do you have? Go ahead.
Okay. Hello, sir. I'm Snigdha Pandey, and I hail from Dhanbad as well. So my question to you is...
You hail from Dhanbad?
Yeah. So what advice do you have for the young investor today? Like, there are so many avenues available, and experts always suggest that you should diversify your money. So do you agree to it? And if you agree, then what avenues would you suggest investors to allocate their money to?
Well, first and foremost, before you start getting into money and all those things, you have to read. Just read like a maniac. Read like, your life depends on it. Investing is an outcome of how much knowledge you have. And knowledge not necessarily just in finance or in balance sheet analysis it has to be a wider knowledge. You have to know history, you have to know philosophy, you have to know psychology, you have to know geography. Every single piece of knowledge that you have gotten in your life will come in handy in this business of investing. Again, to take a cricket analogy, a great batsman when playing, you seem very simple, right? You say, even I can do this. But you can't do that. Okay? When Virat Kohli is batting, you say, what's the big deal? You're hitting over mid-wicket. But how much work has gone into getting that perfection? That you have no idea. It's the same thing in investing. All that I'm saying seems very simple, very logical, but it's hard to execute, but you will find it getting simpler if you're built in, particularly in this age. This and for the next 5-8 years of your life is your golden period of knowledge gathering. The investing and the harvesting part will come later.
So apart from business and crime fiction, which I understand you enjoy, what books would you advise our young readers to look at?
I mean, again, it depends on your style. Again, see the important thing here in investing also is when you have read a lot and then you've done a bit of investing, you will discover your own failings, your own weaknesses, your own strengths, but more importantly, your weaknesses. And in large part, your personality will determine what kind of investor you are.
Okay, before we go grab our next book, what's the question that you have?
Good morning, sir. My name is Suraj. I am currently pursuing Global MBA at SP Jain with specialization in global logistics and supply chain management. So my question is, you founded First Global at the age of 26, an age when most are still looking at what vocation to take up. So what have been some of the mistakes you made, some key traps you would advise the investors to avoid?
No, my decision to get into business was already when I was doing my MBA. I was very clear I didn't want to work. I wanted to be in business. And Citibank used to pay some 2,000 rupees a month, 4,000 rupees a month back in the early 90s. So there was not a lot of money. And I wanted to get rich. I mean, as I said that, from 1982 when my father died, that was my single point agenda. So stock market I'd been doing till the time I was 26. I'd been doing it for 10 years, remember. So I started at 16 or 17. So I already knew the potential it had. And remember, it was very infancy in terms of the stock market in India. But given that 10 years that I had under my belt before I became 26, I just knew this is what I was going to do. So yes, 26 was a young age, but in hindsight, I think, it was an age I could have taken some risk at. The older you get, the less risk you are likely to take. I mean, frankly, today I can't take the risk I could take, in 20 years back. I'm scared. Okay, I don't have the guts that I used to have 20 years back. It's not possible. When I think back, I used to say I was mad to have to take that kind of risk on trading, where a 1 point movement can mean literally millions of dollars. And frankly, I don't even need to take that risk anymore. So at younger age, you can take some risk. Okay, so I took that risk. It worked out. The traps are very simple. If you're trading means leverage. Okay, then it's not about the good trade. It's only about risk management. Your life as a trader will depend not on how good you are at identifying great trade, but how good you are at risk management. And that is the central thing, very hard to do. We all make mistakes in that. But if you can manage your risk, manage your loss, cut your loss. I'm talking trading, not investing. That trading and two completely different things. Then you have got longevity. And I traded a lot in the 90s. I do not trade anymore at all. So I do not even look at the screen. But in that also, we made a lot of mistakes, I mean, it was just a nightmare. In 96, I was short. 97, I was short Infosys or something, 98. And the stock went up 2-3 times, and I never cut my shorts, and I remember how much money I lost. And it was very stupid. I mean, I should have been out of the trade when I was down 20%.
Okay, so the older you get, the less riskier also you get. And let's get in the last question then from our students. Go ahead.
Hi, sir. My name is Pranay Shah. I'm part of the Global MBA cohort here. My question is around the startup ecosystem. So it's quite a buzzword these days. Some really commanding valuations which are not justified. So what do you make of the startup story?
Particularly when you take VC capital. And I had a meeting with, there was something we were working on. I'm meeting with with a VC fund and their people who were supposedly knowledgeable in a consumer business or something. And I found them, there were kids with 2 years experience in ITC in Hindustan Lever, and they're supposed to tell me about consumer business. I mean, 2 years in ITC in Hindustan Lever, you're meeting, the panwala and the dukanwala to convince them how to keep your crisp and, chocolate or whatever it is. You learn nothing about strategy and what is consumer business. But just because you got 2 years on your resume, you suddenly become part of a VC fund, and now you're supposed to advise entrepreneurs on how to run a consumer business. I mean, that's ridiculous. So when a kid is advising another kid, I think the outcomes are very, very clear. What happens as a result if something successful is pure luck. And I've always said this, VC investing, I do not count it as a skill at all. When they themselves say that my data tells me that only 30% of the time we make money. 70%, 30% is average and 30% is a write-off. I said if my strike rate is 30%, that's worse than a toss of coin. Correct? Then where is the skill? Skill has to be a 70, 80% strike rate. Then you're talking real value-added skill. 30%, any idiot can then keep tossing coins and 50% right. So there is no skill that I know of in VC investing. There is skill in secondary market investing, and there are Soroses and Warren Buffetts. I mean, you can look at the track record. The data is there. The rest of them will get one Facebook and you suddenly make so much money that the rest of it is drowned out. Okay? So that is what skill is that? That is not skill, that's pure luck. So I believe that if you take VC money as a young entrepreneur, while there is an opportunity, you might make something meaningful. In large part, you're probably likely to fail because the business model that they'll be forcing on you will be a cash-guzzling business model, full of losses. It won't be a slow, steady pace of growth. It'll all be just go, hell for leather, like a 2020 game. Now, business is not a 2020 game. Business is about a series of 5-day games permanently. You end up playing 2020 in a 5-day format, or vice versa, you know what the outcome is going to be. So what you're seeing is the result of very poor thinking of how to run businesses. And look at the capital that Snapdeal is plowed through $2 billion of capital. Good companies can't get $2 billion. And you have a bunch of kids getting $2 billion for what? If to make a loss, you give me 2 billion, I will make it into 1 million. What is the big deal in this? Yeah? That's crazy.
Shankar, I've discovered that as much as you love the markets, you also love cricket. We keep touching upon that. But I want to squeeze in one last question. Any risks to the kind of rally that we've seen?
At least for the next few quarters, I do not see a risk.
Okay.
Risk will come. That is part of the game. As of right now, I do not see any major risk to the Indian small cap, mid cap story, for sure.
From Amazon to startups to the government and the Indian markets, we've discussed practically everything. So thank you so much, Shankar, for taking time out and joining in today. With that, it's a wrap on the show. Thanks for watching.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.